Assalamualaikum everyone. Good evening. Hopefully everyone is doing great. Everyone would be okay. Our today's session is about the WACC. The topic is how to calculate WACC practically. I have told you many times that I am working in a merger and acquisition department and investment valuation, and my daily job is to appraise the new projects, to value the new companies. And whenever we are valuing any company, whenever we are valuing any project, whenever we are doing investment appraisal of any project, we have to calculate WACC. And we know how to calculate WACC after studying financial management of ACCA, after studying advanced financial management of ACCA, or after studying CFA level 1 or level 2. We know how to calculate. But that is bookish knowledge. Practically, it is different. Not exactly different, not at 180-degree, no. It has some variation, it is different. So that's why I have arranged this class to guide you people that how to calculate it properly. Because after doing ACC, after doing CFA, you will be stepping in the practical world. So I really don't want that you people have to face any difficulty there. You should be equipped well with the practical knowledge that how to do it. And I know it in my company, majority of the chartered accountants, ACCA, they don't know how to calculate this. Only person who is actually working on valuation, only person who is actually working on merger and acquisition, that person will know that how to calculate this. And this is different. Every chartered accountant, every ACCA, every CFA, normally they study how to calculate WACC in their study journey. But practically it is different. So I am working in finance, and in reporting department, there are many chartered accountants, many ACCAs even. They know how to do the accounting, but they don't know how to calculate the WACC because they are not doing it practically. So practically, how to calculate it? So we will learn today. We will learn how to calculate WACC of a public listed company. We will learn how to calculate WACC of a private company, and we will learn how to calculate WACC of a private company having two divisions, having more than one division. Even this was a topic of AFM as well. So let's start. I will start from the basics. I will start from the WACC. Then I will take you people to the Excel sheet. So before the Excel sheet, let's discuss how to calculate the WACC. So WACC is weighted average cost of capital. Weighted average cost of capital. In order to calculate WACC, in order to calculate weighted average cost of capital, you people should know that what is cost of equity. You people should know how to calculate cost of debt. And if you're able to calculate cost of equity, multiply it with proportion of equity. So what we will do, we will take the equity proportion divided by equity plus debt. And then we will calculate the cost of debt and multiply it with debt proportion. That is debt divided by equity plus debt. So I'm not explaining from any course perspective. I'm not explaining from ACCA, CFA or CA perspective. I'm explaining from practical perspective. And my approach can be different from the other approaches. There are different approaches. But overall, it would be 99%, it would be same. So how to calculate cost of equity? Number one cost of equity. How to calculate the cost of equity? So we will start with cost of equity. We will calculate cost of equity using CAPM formula. And the formula is cost of equity is equal to risk-free rate plus beta into equity risk premium. Okay. So there are two approaches which are common in order to calculate the cost of equity. Number one is this approach. And there is another approach. That is cost of equity is equal to risk-free rate plus beta into equity risk premium plus country risk premium. Plus country risk premium. So these are the two formulas which are very famous. So we are studying WACC. Number 1 point is cost of equity. Number 2 point is cost of debt. Number 3 point is proportion of equity. Number 4 point is proportion of debt. So we will start from the number 1, cost of equity. Okay. So let me take 2 examples. I will explain 2 formulas. Let me explain the number 1 formula. If you are using this formula, and for example, select any country. Obviously, I belong to Pakistan. We can take the Pakistan example. Currently, I am in Saudi, so we can also take the Saudi Arabia example. So where to take the risk-free rate? Risk-free rate should be either 5-year or 10-year government bond. For example, if my project life is 5-year, I will take 5-year bond of Pakistan. And Pakistan 5-year bond is called PIB, Pakistan Investment Bond, PIB. And if my project is of 10-year, so I can take 10-year yield of Pakistan Investment Bond. If you are calculating the value of any Saudi company, so you will take 5-year yield of Saudi government bond. If you are doing analysis of sitting in India, so you will take 5-year or 10-year yield of Indian government bond. So let's suppose we are in Pakistan. So I will take Pakistani company. So I will take 5-year or 10-year government bond yield of Pakistan. So why 5-year? If your project is having a life of 5 years, then you should take the risk rate of 5-year government bond. If your project is long term, more than 5 years, 10 years, then you can take 10-year government bond yield. However, the 20 years or 30 years government bond yield is not that active in our country. In US, 20-year bond yield is active. 20-year bond is also active. But normally you can use 5-year or 10-year government bond yield. Okay, from where you can find this? In Pakistan, you can find this from State Bank of Pakistan website. In KSA, you can find from the Central Bank of KSA website. In India, you can find this from the Reserve Bank of India website. Or there are many websites available where you can find this type of data. And the best source is Bloomberg. Best source is Bloomberg, but Bloomberg is paid. So we will take the risk-free rate. Okay, sir. What about the beta? We will discuss beta on Excel. But let me clear this as well. If it is a public listed company, we will run regression of stock price movement of our company with market index movement. Sir, what is this? We will regress, we will check how our stock is moving in comparison with the market. I'm explaining a very simple term. We will analyze that how our stock is moving against the stock market. If our stock is more volatile than the market, then our beta is greater than 1. If our stock is less volatile than the market, then our beta is less than 1. So there is a function and there is a function called slope in Excel. We will using this function, using this slope function, we will calculate beta for public listed company. Okay, sir. What about the private company? Okay, for private company, we will search similar companies called proxy company. For example, if our private company is in cement sector, we will search similar companies in cement, but it should be public listed company. We will search similar public listed company, similar public listed companies having same nature of business. We will ungear or unlever. Ungear, the most practical word is unlever. Unlever the beta of similar public listed companies and relever it with our company debt equity ratio. Okay. So let me explain. We are studying cost of capital, WACC. Number one is cost of equity. We have to calculate cost of equity, we have to calculate cost of debt, then we will calculate weight of equity, proportion of equity. Then we will calculate proportion of debt. Okay, sir. Let's start with cost of equity. Cost of equity, there are two formulas which you normally use practically. Okay. Number one is this. You have studied this in FM, AFM, CFA. Risk rate plus beta into equity risk premium. Okay, sir. This is second formula. We will discuss second formula later. So we are discussing the first formula. Risk-free rate. From where you will take risk-free rate? You can find risk-free rate of your government bond from the central bank website. Or there are many websites available on which you can find the yield of your government bond. 5-year or 10-year, you can take one of the bond yield. If your project has a long life, take 10-year. If your project has a short life, 5-year, 6-year, then you can take 5-year bond yield. Okay, sir. Beta. If it's a public listed company, then you have to make table. You will take your stock movement and you will take the stock market movement and you will run the regression. It is called regression. And using a slope function of Excel, you will calculate the actual beta. By the way, very many websites are also available to calculate this, but you can also do on the Excel. Okay, sir. What about the private company? Private company, what is the nature of private company? Sir, Simit. So go to the stock market, identify the similar nature of cement companies, unlever the beta of those companies, and relever it with your company debt equity ratio. And we will do it on the Excel, like after few minutes. Okay. Two things now. Equity risk premium. Equity risk premium is you will calculate. Equity risk premium is like this: return of stock market minus risk-free rate which you have taken above. Okay, sir. How to calculate this RM? You will estimate historical stock market return of like last 5 to 10 years. Why I'm saying 5 year? Because if you take 10 year, there is a problem in 10 year. There's a COVID time in between those 10 years. And in COVID, stock market was like this. Before COVID, market was going up. In COVID, market went down, not that much. And after COVID, market again went up. So if you take 10 year, 10-year history is not that 10-year have some outliers. So that's why it is better to select time wisely. सोच समझ के आपने time select करना है. Like in last 5 years, there was no abnormal event. If we talk about year 2021 onwards, there was no abnormal event, all smooth. But if you take last 10 years, there was an abnormal event, COVID. So select the time accordingly. Try to identify that time where you don't have any abnormal event. So you can take the historical stock market return of last 5 years and 10 years, that is RM. Minus RF, that would be equity risk premium. Okay. There are many websites where equity risk premium is available, already calculated. Bloomberg. On Bloomberg, equity risk premium is already calculated. Or on average, RF is risk-free rate. RF is risk-free rate. Okay, you can, how to calculate RM? Either you can find it from many websites, or you can take the historical stock market return of last 5 years or 10 years. That will be your risk-free return of stock market. On average, historically, equity risk premium is normally believed to be equal to 6%. It is believed to be equal to 6%. But you should take the actual one by calculating, either by calculating the historical stock market return minus risk-free rate, or you can also get this ERP from the website. For example, in my company, we usually take it from the Bloomberg. We don't calculate it. We usually take directly from the Bloomberg. Okay, what was the formula? It's cost of equity. Risk-free rate plus beta into equity risk premium. So risk-free rate, I'm assuming in Pakistan is 10%. I'm just assuming. Okay, for example, beta is 1.5. And equity risk premium is believed to be 6%. This is subjective, but is believed to be 6%. So when you solve this, that would be your cost of equity. That would be your cost of equity. This is one approach. Okay, there is another approach which we usually follow in my company. I follow this approach, the second one. Cost of equity risk-free rate plus beta into equity risk premium plus country risk premium. Okay, sir. How you do this? We usually take risk-free rate. Okay, this is a Saudi company. You can also do this for Pakistani company as well, but concept is same. Risk-free rate. I will not take the risk-free rate of Saudi government. I will take risk-free rate of US bond. Okay, sir. Beta, same approach, which we have discussed for private company and public listed company. Equity risk premium, I will take equity risk premium of US stock market. So source, there are two very famous sources of this data. Bloomberg. And another source is, there's a very famous professor of New York University, Professor Damodaran. Damodaran, the beauty of Damodaran is he published the data after every 6 months, I think. But every year he published the data. You can take the risk-free rate from the Bloomberg, not the Damodaran, from the Bloomberg or from the government website. And you can take the equity risk premium from Bloomberg or Professor Damodaran. When you search it, Google it, you can go to the professor website, you can open equity risk premium is there. But the problem is, this is US government. This is US government. Then you will add country risk premium of Saudi government against the US. Country risk premium of Saudi government against US. Okay, sir. From where to find this country risk premium? Either Bloomberg, either Damodaran. Bloomberg is very expensive. In my company, we have the Bloomberg and there is a $30,000 annual charges for that. And Professor Damodaran data is free. So you have to prioritize which data you are going to use. Both are very famous. Every other investor banker is using these sources. Okay, if it is a Pakistani company, how you will do it? Take the risk-free rate of the US, take the equity risk premium of US, take the country risk premium of Pakistani government against the US. Okay. So these are two approaches. If you are living in Pakistan and you want to analyze the company of Pakistan, the first approach is good. Take the risk-free rate of Pakistan, take the beta of that company, take the equity risk premium of Pakistan. And if you are living in Pakistan and you want to evaluate another company in another country, for example, you are sitting in Pakistan, you want to analyze European company, you want to analyze American company, you want to analyze Saudi company, you want to analyze UAE company. So then the best approach is you can take the risk-free rate of US government, take the equity risk premium of US stock market, then take the country risk premium. Sir, why US? US bond is the most liquid bond in the world and the most tradable bond in the world. US stock market is the most liquid and most tradable stock market in the world. So this is, if you take these three data, this is the cost of equity of US company. When you add this, then it will become cost of equity of your company. So the simplest approach is take the risk-free rate of US government, take the equity risk premium of US market, take the beta of your company, and then add the country risk premium. So if your company is, for example, in South Africa, take the risk-free rate of USA, take the beta of your company, take the equity risk premium of USA, take the country risk premium of South Africa against US. By the way, country risk premium is always available of every country against US. Okay, because USA bond is actually considered to be the risk-free bond. So these are the two approaches which you can use, and cost of equity will be near to each other. There will be not there wouldn't be any huge difference. Okay, sir. Next, cost of debt. Different approaches. Number one approach: go to the financial statement of the company, calculate the interest. We can use this second approach for the companies even in your home country as well. Okay, cost of debt. Go to the financial statement of the company, calculate the finance cost. Finance cost. Divide by all interest bearing debt. All interest bearing debt. This would be effective interest cost. This is number one approach. Go to the financial statement of the company, calculate the finance cost. It is given. Income statement में finance cost given होती, right? And calculate, identify all interest bearing debt. So what is the meaning of interest bearing debt? Bank loan, lease, short term liabilities where you are paying interest. Okay. All interest bearing debt. Calculate the effective interest cost. And cost of debt would be after tax cost of this. Effective interest cost, effective interest rate into 1 minus t. This is the simplest approach. Okay. I will take all the questions. So if the company is in Pakistan, then you will take the tax rate of Pakistan. If the company is in Europe, you will take the tax rate of Europe. It depends, na, kahan wo company. This is one approach. Or another approach. You are reading the financial statement. You know that company has taken loan at Khyber plus 2% spread or LIBOR plus 4% spread. Calculate the interest cost and take its after tax value. This is also one approach. Okay. And if the debt is variable debt, and every 6 months or every 3 months interest rate will change. So then there is another approach. You will identify a swap rate. This is kind of a more practical, but swap rate is available from, like you can identify swap rates from Bloomberg, or it is also available from the government website. And plus spread into 1 minus t. So when to use this swap rate? If there is long-term variable interest loan. Okay. Obviously, in my company, we know the financials, so we normally use this first one. But in some projects, in project finance, if I know that I will finance my project with a variable interest rate loan, I will take 10-year loan and I will finance that loan. I will finance my project with that loan. Okay, sir. What is the interest cost of the loan? Interest cost of the loan is variable. I will take the LIBOR, KIBOR, SIBOR, Euribor. It is like in Pakistan, it is KIBOR. In Saudi Arabia, it is SIBOR. In America, it is SOFR. In Europe, it is Euribor. So that will change after every quarter or after every semi-annual or 6-month period. So I want to take one rate. You will convert all the floating into fixed rate, that is swap rate. Plus spread into 1 minus t, that is your KD. But the best way, the simplest way is the first one. Calculate the effective interest rate into 1 minus t. That's it. Simple. If more information is given, LIBOR plus spread into 1 minus t. If you want to calculate deeply, then you can use this approach. T means tax rate. T means tax rate. T means tax rate. T stands for tax rate. Okay, sir. Next, proportion of equity. You will take market value of equity. Obviously, in public listed company, in private company, it would be book value divided by market value of equity plus book value of debt. So why, sir? Hardly any company issues the bond. If it is bond, that means then you will take the market value of the debt. Bond trade hota hai na? Bank loan is not tradable. Debt is normally bank loan. And in case of bank loan, you will take book value. If debt is bonds, loan stock, then you will take market value. Okay, sir. What is proportion of debt? Debt value, normally book value. But if there is a bond, then you will take market value. Market value of equity plus debt value. In case of private company, you will take, that would be book value and equity will also be book value, because in private company, market value will not be available. Okay, what is the meaning of book value of equity? All equity, all total equity. So what is the meaning of debt? All interest bearing debt. All interest bearing debt. So what is the meaning of interest bearing? Any borrowing on which you have to pay interest. All liabilities are not interest bearing. There is a liability called deferred tax liability. No, deferred tax liability is not a loan. In debt, you will take interest bearing liability. Equity will include everything. Everything in case of book value. All reserves. Okay. That was a quick recap. Now I will move to the Excel sheet. Okay. First of all, we will Consider for a publicly listed company. For a publicly listed company, okay? This is the built-in sheet. When you put data, it will give you the answer. For publicly listed company, firstly, we will calculate the beta. So this is a beta calculator. I have taken data from 2019 onwards. This is all, this data is just assumed data. Nothing is actual. 2019. And this data is available till 2025. Okay. Okay. What data you need? You will take the index value movement, index movement. If you are in Pakistan, we have a very famous index, KSC 100 index. We have a very famous index called KSC 100 index. Okay. Let me show you. Today, KSC 100 index moved to 133,370. And historical movement of KSC 100 index is available on this website, pakistanstockexchange.com. It is available. Okay. So if you want to calculate beta of any public listed company of Pakistan, for example, you want to calculate beta of Millet Tractor, you will take the KSC 100 index movement of last 5 years. You will take the Millet Tractor share price movement of last 5 years. So this is a weekly movement. If you look at it, 7 June, 14 June, 21 June, 28 June, 5 July, weekly movement. You can also take daily movement. It's up to you. You can also take daily movement. Index close price. Okay, so what is this? This is a change, percentage change of index. Closing minus opening divided by opening. This is stock price movement. You can take the stock price of any stock price of any company. This is the change of the stock. So first of all, you will write all the dates. Second, you will write all the index price movement. Like if you want to calculate for the Pakistan Stock Exchange, so our KSC 100 today is 133,370. Today market moves by 1,421 points. So yesterday, on Friday, yesterday means on Friday, it was 131,900 something. It is available. Yes. Daily stock price movement or the weekly stock price movement or the index movement is available. You will take the index movement. You will take the change of the index price. How, sir? Closing divided by opening minus 1. Or closing minus opening divided by opening. You can also do this. Same. Stock price movement and change. So look at the data. This is for 5 years. More than 5 years in our case, but you can take the 5 years. So how to calculate the beta? This is the, if you want the graphical approach, how two are moving with each other. So one thing which is very important, index is independent factor and stock is dependent. Stock is dependent and index is independent. stock price movement is dependent and index is independent. Okay. So let's calculate the beta. Although it is calculated, but let me calculate it for you again. You will write slope, formula SLOP, slope. Bracket start. Knowns Y. You know y-axis and x-axis? You guys know, right? Y-axis and x-axis. Which one is independent? Which is dependent? Which is dependent variable, y or x? Dependent. No, independent, not dependent. Which one is independent? Anyone? Stock is dependent. So let's do it. Slope, bracket start, y. You have to take all the percentage return starting from here. Okay. Comma. Point 9085. This is our beta. This is our beta. Okay. So the formula is SLOP slope. You will, firstly, you will take the Y factor, the dependent factor, stock price movement, stock price change. Then you will take known X, the independent factor, that is index price change. Okay. Once you calculate the beta, now the life is easy. Now let's try to understand this sheet. Effective tax rate is 30%. I've assumed effective tax rate is 30%. Okay. How stock is dependent? Stock index is whole market, and stock is one component of the whole market. Okay. So we have to check that how our stock market is behaving against the index. How our stock is behaving against the index. That is beta. Okay. Effective tax rate. Then risk-free rate. I have taken 10-year risk-free rate, 4.7. This is US market. Okay. Market risk premium, 4.6%. Market risk premium or equity risk premium, both are same. Country risk premium is 1.03. This is for Saudi Arabia. For Pakistan, it is much higher. It is higher for Pakistan. Even for India, it is higher. Okay, debt divided by debt plus equity is 15.5%. Debt over equity is 124.8%. And cost of debt is 5.7%. So every data is there. Our company total debt is given. Our company total equity is given. So if you look at this, we have calculated this debt divided by debt plus equity. Debt divided by debt plus equity, 55%. Okay. And debt over equity is debt over equity, 125%. I will answer all your questions. Let me finish this first. Okay, this is calculation. If it is a publicly listed company, equity value would be market value of shares. If it is a private company, then you will take the book value of equity. Okay. Market risk premium or equity risk premium is 4.6. This I have taken from above. These are the assumptions. These are the inputs. Okay. Market risk premium is 4.6. Beta was, what was our beta? 0.9085. 0.9085. This is market risk premium, adjusted market risk premium. Once you multiply the market risk premium with the beta, that is adjusted market risk premium. So we will add the equity risk premium, sorry, risk-free rate plus the country risk premium. So total is cost of equity, 9.91%. I have used the second approach. You can also use the first approach. It's up to you which approach you want to use. So equity risk premium, let me name it equity risk premium so that you should, otherwise you will be confused. No? 4.6, it was stated above. Beta we have calculated separately. 4.6 into 0.909 adjusted market risk premium. Plus risk-free rate plus country risk premium, this is your cost of equity. Okay, multiply the cost of equity with the weight of equity. So how do you know the weight of equity? Equity divided by both, the sum of these two. If debt is 55, equity is 45. Okay, then you will calculate cost of debt. Cost of debt was 5.7, tax rate is 30%. It is, after tax cost of debt is 4%. Multiply the cost of debt with the debt proportion and then add these two. Add these two. That is our WACC. That is our WACC. That's how you will do for the public listed company. Okay, sir. What about the private company? For example, your project or your company is in cement. So how you will calculate the beta? You will go to the stock market website and identify similar nature of companies. You will identify similar nature of companies. Okay. For example, I have found 1, 2, 3, 4, 5, 6 companies. Okay. Write the tax rate of those companies, effective tax rate of those companies. In Pakistan, tax rate is 29%, you know. But all the companies are not paying 29%. For example, the bank effective tax rate is more than 50%. So you will take effective tax rate. So how to calculate the effective tax rate? Calculate the P&L tax divided with EBIT. That is effective tax rate. Income statement जानते हैं ना आप लोग? Income statement, you will start with revenue minus COGS, gross profit minus OPEX, earning before interest and tax, minus interest, then EBT, and then tax. Divide the tax with over EBT. Okay. So these would be the tax rate of proxy companies. Okay. This is the levered beta. So how to find these betas of these companies? You can find it from Bloomberg. You can find it from Google or Yahoo Finance, or you can also find these betas from different websites. Plus, you can also calculate these betas using the same approach which I have explained earlier, using this approach. Levered beta. Levered beta is geared beta or equity beta. In books, you have studied it, beta equity. Write the total debt of that company, write the market value of equity of that company. This is debt equity ratio. This is unlevered beta, ungeared beta, or beta asset. So what is the formula? This is the formula to calculate beta asset. This is the formula. In AFM or in FM, we are also using the beta similar to this. But our approach is little different, but answer would be same. So how to do it? In this way. How? Starting with levered beta divided by 1 plus 1 minus tax rate into debt over equity, bracket close, 0.189. Okay, these are the ungeared beta, unlevered beta of all proxy companies or beta asset. But if you look at this, there are some outliers. Highest is 0.91, lowest is 0.189. So don't take the average. Although in books, in our paper, we take the average, but here you will take the median. Median will remove the outlier. Outlier कहते हैं जो one of very low or one of very high. That is outlier. So if you take the average, average is 0.65. Average will take the impact of outlier. But median will not consider the impact of outlier. So practically, median is more acceptable. Okay, practically median is more acceptable, 0.7. This is beta asset, unlevered beta. You will use the company debt equity ratio and levered it. For example, tax rate is 10%, levered it using this formula. So how? Beta asset into 1 plus 1 minus our tax rate into debt equity, 1.48. Rest is same. This is the imports effective tax rate, risk-free rate of, this is the US comment. Market risk premium, credit risk premium, debt equity ratio. This is same, exactly same. Just put the beta here. Cost equity into equity proportion. And this is the WACC. That's how you will calculate the WACC. This is for the private company. Private company beta will be calculated using the unlevering of the beta of similar companies. Okay, this is the most difficult part. Not for you people, but practically. If your company is dealing into two sectors, two divisions, okay, no issue. Only problem is with the beta. So for example, my company is in cement and my company is in automobile. Example is Lucky Cement. Lucky Cement is also in cement business, plus the Kia Motors is also under the Lucky Cement. Nishat Textile as well as the Hyundai. They have the Hyundai brand. Okay. Hupco Power Company, now they have launched the BYD. So identify all the proxy companies of cement. Okay, tax rate, levered beta, total debt, total equity. You can find this data from the website. Debt equity, unlevered debt. Calculate the median of cement industry. This is the median of cement. Cement sector. Cement division. Okay, do the same thing with the automobile. I have identified 6 companies. You can find 2 companies, 3 companies, 4 companies, whatever the proxy companies you got. But it should be similar. Median of automobile companies. So 0.71 and 0.64. Now take the weighted average of these two. So in our company, 33% belongs to cement and 67% belong to automobile. Our company is earning 33% from the cement and 67% from the automobile. So how do you know? This is just an example. You have to divide the two division. You have to give the weightages to the two division. Number one, the best way of weightages is revenue. And the second is assets. How much worth of assets belong to cement? How much worth of assets belong to automobile? This is one way. Another way is how much you are generating revenue from the cement, how much you are generating revenue from the automobile in total business, in total revenue. So we are generating 33% from the cement, we are generating 67% from the automobile. Okay, now using these two weights, calculate the weighted average beta. How, sir? Cement beta into cement weight. Automobile beta into automobile weight, 0.66. Then take our debt equity ratio, our tax rate, re-levered it, 1.2, using this formula. Okay, so done. We have done the re-levering. Then the same sheet, everything is same. Put all the inputs, you will calculate the WACC. That's how you will do it. That's how you will do, how you will calculate the WACC practically. By the way, it looks like it is much simpler compared to the WACC we used to calculate in AFM, right? If company is newly listed, that means history is not available. So then the best approach is try to identify the similar companies, just like private company, and unlever the beta of those similar companies, take the median or average, and re-lever with our debt equity ratio, and using that approach, calculate the WACC.
Yes, sir.
Okay. जी, any other question? जी, Junaid, please ask.
Assalamu alaikum, sir.
जी, Manan sir, please.
First, thank you so much, sir. Appreciation belongs to you, कि सर आपने हमें इतना ज़्यादा practical knowledge दिया, experience दिया, sir. Thank you so much. First. On the other hand, sir, since this class is not related, तो सर मैं भी एक unrelated question करना चाहूँगा, सर. ये देखिए, ये जितना भी सारा डाटा है, ये historical based है, और आपने एक बात की कि हम 5 to 10 years लेंगे. और अगर आपने कहा प्रेफरेबल यही है कि आप 5 ईयर लो, क्योंकि अगर कोरोना चल रहा था तो 10 ईयर्स के ऊपर चीज अनसर्टेन हो जाएगी. सर ये गाइड कर दें, अगर प्रोजेक्ट ही 10 ईयर्स का है तब हम कितना लेंगे. और दूसरी चीज ये कि सर ये देखें, ये सारा अज्यूम डाटा है, ये हमें रियल लाइफ के अंदर इतना बेनिफिट किस तरह कर रहे हैं. हम देख रहे हैं कंपनीज ग्रो करी जा रही हैं, ये इतना एग्जैक्ट किस तरह है. हमें कोई इस तरह की एग्जांपल दें कि इस डाटा की वजह से कोई डिस्ट्रक्शन क्रिएट हुई हो, कि हमें पता चले ऑन स्पॉट.
Nothing is exact. All of this is assumption. If project is long term, like if project is 15 years, 20 years, or 10 years, take the long term risk free rate. Like 20 years risk free rate is also available. 10-year risk free rate is also available. 5-year risk free rate is also available. But if you are only taking the project of 5 year, take 5-year risk free rate. If you're taking the project of 10 year, 10-year risk free rate. If your project is long term, then you can take the 20-year risk free rate. पहली बात ये. Then instead of taking the corporate tax, calculate the effective tax rate. How much companies effectively paying? Like in Pakistan, corporate tax is 29%. But banks, like let me give you the example of Mizan. Mizan Bank effective tax rate was 52, 53%. More than that even, 55%. So calculate the effective tax rate. Zakat rate, zakat or tax यहाँ पर same ही है ना? It is same. If it is a foreign entity, so you have to pay 20%, otherwise you have to pay zakat here. हाँ, super tax शामिल हो गया ना? Super tax is included in that 55%. If it's a Saudi company, you don't have to pay tax, you have to pay zakat. वो इफेक्टिव टैक्स आ जाएगा, दैट वुड बी इफेक्टिव टैक्स, बिकॉज ज़कात इज वेल्थ टैक्स नॉट द इनकम टैक्स ना, तो फिर अब यू विल टेक द इफेक्टिव टैक्स.
Sir,
लिवर्ड
like,
बीटा मीन,
okay, sir.
Abdullah, just give me 1 minute. Levered beta means geared beta, beta equity. Unlevered beta means ungeared beta or beta asset. Zakat amount will be, yes, as an tax expense. हाँ जी, कोई और somebody else was asking question. Please ask.
Sir, where can we find the country risk premium, sir?
Which risk premium?
Country risk.
Two sources. Bloomberg, it is paid. Otherwise, Damodran.
Okay.
जी, Junaid, please ask.
So my question is with regards to the debt equity proportion. For example, if we are appraising a project with 5 to 10 years of projection, so what would be the debt to equity proportion? For example, will we take the debt to equity proportion of the first year, or you recommend that we take the average debt for the next 5 years? You know, the capital structure which we have assumed for the over the project forecasting cycle
We will take the
over the
target capital structure, which we will
target
achieve
capital
over the
structure.
period.
Okay, so you mean the average debt to equity proportion over the project forecasting cycle?
Yes. Otherwise, it is all it will be misleading, na? Because first
Correct,
year will not apply.
100%. Correct. This is exactly what we do. ठीक है. Thank you.
Any other question, guys? Helenji, I will try to take more classes from the practical aspects. Uh, Maybe this class will be helpful for you people. Junaid, आपने तो company recently acquire की है, so I think you must have used the similar kind of stuff in your valuation.
Exactly. Almost 90% of the things which you have explained, वो हमने use किए. मेरे पास भी ऐसी sheet बल्कि मैंने खुद build की थी. More or
Great.
less, all these techniques were used, and I use these, equity risk premium and all these metrics from Aswad Damodran.
Hmm. Because
And
two sources are very famous, Bloomberg or Damodran. Bloomberg is it's not available everywhere.
it's not available, but if you want to get it, the brokers like AHL or AKD, they share some
Yes.
data from Bloomberg.
Yes.
So I
These two sources are
normally,
famous. Yes.
yes, correct, correct.
Junaid is our CFA student, and Junaid was involved in valuation of Mitchell's, and they have acquired the Mitchell Pakistan. So they have used similar kind of like stuff there. And even whenever you will go to industry in valuation or M&A side, inshallah, you will use this stuff. So that's why I like I've taken this initiative uh, to explain the practical side of finance. There's the revaluation reserve written if you're taking book value of equity, then take the full book value of equity. Anyway, guys, thank you so much for joining, and we will take further session inshallah in future. So please, it is my humble request, always stay connected. You never know, you learn something special and which can appear in your test of job or in interview. You can like tell the story which you have learned today and you can get the job. मुझे याद है, in my job interviews, mostly in job interviews, you have to tell the story. And I always able to tell the story because of my teaching experience. And you guys can tell the story because of these classes. I will share the Excel sheet in our WhatsApp group of CFA and FM and AFM. And if you are not in the recent group, then you can send me a WhatsApp message, but not today. Please tomorrow. I will share this Excel sheet. If you are in a regular batch, you will get it. Don't worry. But if you are in, if you're not in the latest batches, so you can send me the text. You have my number. So I will share this sheet. Thank you so much. Take care, everyone.
Thank you, sir. Once again.